Good morning, everyone. In today's video, I'll share what I like to do when a trade goes against me and how I adapt to the new volatility regime that we're currently in. So first, to set the stage, inside of the S&P, starting off in the morning, we were using our scalper volatility box models. Those were the ones being respected. Now in that 7 to 8 a.m. Pacific hour, we had a fairly consistent sell-off inside of the S&P, where that took us to our first breach for the day. And this is where price action hits our sign entry line. So that's step one of our setup. Once we see that breach, we're looking for this edge signal confirmation, which we got 2 times, along with a retest of our sign entry line. So that's step 2 of our setup, looking for that edge signal along with the pullback to the sign entry line. And at this point, that's where the trade gets filled. It's active. Everything is good. Our stop is outside of the volatility box clouds, which in this case was a risk of right around 9.5 points, which I can show you using the trendline tool. Take the sign line, go to the outer edge of the clouds, rounding up here, so 9.5 was the bare minimum risk. We're looking for that same move on the opposite side. We only made a move to right around 8.25 points. 9.5 would have taken us a little bit closer to our market pulse. So we did not hit what would be our T1 on the opposite side, that same 9.5, before price action then continued to drift down lower. And this big red candle right here was where we had a minus 1,000 tick reading, which is basically a lot of selling pressure or selling program taking place. And that candle took us out of this trade. That was our stop being hit when price goes outside of the clouds. So the question is, what do we do now? Do we continue to use our scalper models, or do we adapt to this new volatility that we're seeing, given that we now have new information that, hey, price is reacting well outside of our scalper models? Scalping is not such a good idea. Of course, add in the fact that it's a Friday, and I think that makes for a recipe where you'd like to adapt to the new volatility, be a bit more cautious so as not to try and be continuously aggressive in a revenge trade for the rest of the day. So here, once we go outside of our scalper, we adapt to our next volatility model, which all 5 are laid out here. It goes scalper, then we can adapt to our aggressive. If we break outside of the aggressive, we adapt to our doomsday aggressive. If we break outside of that, we adapt to our conservative, and finally we have the doomsday conservative as our final model. So in this case, we went outside of the scalper, so now let's see what it looks like adapting to our next volatility model, which is the aggressive volatility model. So using our aggressive volatility box here, we can see this has done a much better job of respecting price action in that same 7 to 8 hour, and is the model to use going forward given the new information we got. So now off of the aggressive volatility box, if we breach either side sign entry lines, that's the new model we're using for our setup. The setup stays the same. We're looking for a breach of either this side or this side, long or short. Once we see that setup, we'd like to see an edge signal confirmation along with an entry at that sign entry line or better, so anywhere really inside of this zone. If we don't see that edge signal prior to going outside of our clouds, that's our sign to adapt to volatility one more time, and we go to the doomsday aggressive. And we have 5 models available to us to try and capture the volatility we're seeing. Now, one additional note to add, given that it's a Friday, is we like to stop our trading in that 9 to 10 a.m. Pacific hour, mostly because funky things tend to happen as the day goes on. We have less time for follow through. It just makes sense to shut the screens off at that point, take the rest of the day off, and just observe and learn as opposed to put actual capital per risk. So as of right now, in the S&P, we're on the aggressive volatility box model after this one candle stopped us out of the scalper. So that was currently a minus 9.5 on each contract times 2 for those of you that take 2 contracts. And we're looking for our next breach using the aggressive model, and we have the 8 to 9 a.m. hour along with the 9 to 10 left, so 2 more hours left for potential trades to try and make back some of those losses. Alright, hope this video helps to give you a side of the other picture when trades go against you, how to adapt to the changing volatility, how to react, and what model to use for the remainder of the day, or at least for the next hour onwards, until we get new information and price gives us new clues. Alright, take care everyone, good luck trading, and have a great weekend ahead.